Hello, welcome to Air Education. So for today's video, we're going to talk about the different accounting concepts and principles. So these accounting concepts and principles are actually adopted to the book of Florendo 2016 entitled Fundamentals of Accounting, Business and Management 1. So what are the different accounting concepts and principles? Let's get started. So we have 10 accounting concepts and principles according to Florendo 2016. So what are those? So we have accrual accounting, matching principle, use of judgments and estimates, prudence, substance over form, going concern assumption, accounting entity assumption, time period assumption, and 9. Generally accepted accounting principles or the GAAP, and the last two standards in accounting are the International Financial Reporting Standards or IFRS and the Philippine Financial Reporting Standards or PFRS. Now, PFRS rather. Now, let's proceed to the accrual accounting. What do we mean by accrual? So, accrual accounting is based on the fundamental idea that the effects of business transactions should be recognized in the period which they occurred, meaning the moment the financial event of the business happened, immediately the business needs to record or recognize that particular financial event. What are the examples of accrual? So we have in income and expenses. So in income, the income should be recognized in the period when it is earned, regardless of when the payment is received. Uh, this only means that the moment you render your service, the moment you give service to your clients, you need to record that immediately on the accounting book, even though it is not yet paid. So that is under accrual accounting. Even though you don't receive a payment, you need to record that on the financial statement because you already rendered a service. Okay? How about in terms of expenses? So in terms of expenses, the expenses should be recognized in the period when it is incurred, regardless of when the expenses are paid. So, it's actually have the similar nature with the income. However, the expenses is within the business. You are the buyer or you are the consumer of the services of other people. So that will be your expenses. So meaning even though the expenses are not yet paid, but these expenses are already incurred, you need to record that on the financial statement. So meaning, in short, under accrual accounting, no cash involved because in expenses, just like the electricity, we are consuming first the electricity before making a payment. Okay? Again, under accrual accounting, no cash is involved. Okay? Now, next. Aside from that, actually, accrual accounting has this essence that accountant does not wait for cash to be received or cash to be paid before he or she records a business transaction. Just like what I've said, accrual accounting does not involve any amount of cash. What else? Okay, accrual accounting is the opposite, of course, of the cash accounting because cash accounting is where income and expenses are being recognized when there is cash involved, either received or paid, depending on the nature. If it is income, of course, when cash is received, and if it is expenses, if cash is paid. Okay? So again, when we say accrual, there is no cash involved. How about the matching principle? So matching principle is actually related to accrual accounting. In what sense? Because under matching principle, the word match, okay? We need to remember that the expenses is always in a relationship with revenues. When we say in a relationship with revenues, the moment you receive a revenue, there is an underlying expenses on that particular income. You can't earn an income if you don't incur any expenses. So for example, Miss Aliyah invested in a milk tea shop or invest in a milk tea shop. Her monthly revenue in the shop is 100,000. Every 20th day of the month, Omeco or the electric cooperative in her town is billing her an approximate electricity consumption of 5,000 pesos. So under matching principle, the amount of 5,000 under the utilities expense will be recorded in the same period related to the 100,000 revenues. Because again, without the electricity, the business will not grow, or the milk tea shop will is impossible to operate. Therefore, any revenue or any expenses related to the revenue of 100,000 should be recorded at the same or in the same period. Okay? Again, when we say matching principle, always remember that if there are revenues to be recorded, there should also be an underlying expenses related to that revenue. How about the third one, the use of judgments and estimates? So there are the approximations made by accountants or the management in the preparation of financial statements. So in accounting, we use also approximations or an estimates to measure the value of a particular account in a financial statement. So it is an essential part in the preparation and does not undermine their reliability. But please take note that there are only a few accounts related to the use of judgments and estimates, because this principle or this concept should not be abused. In what sense? So for example, a warranty expense, okay? This particular account or this expense cannot be measured precisely by the company, because the moment the customer paid for the equipment, for example, you are selling equipments like refrigerator, television, washing machine, any kind of equipment that needs to have warranty. So for example, you're selling that kinds of merchandise, you are not sure how much warranty does an item cost, because it depends on the damage, right? So Warranty expense are not guaranteed, or warranty expense is not a guaranteed cost that is made by the seller, because you just promise, or the seller just promised to repair or replace the thing sold if necessary within a specific specified period of time, meaning she or he doesn't know how much or when the expense, or the warranty expense, will be incurred, or will be incurred by the company. Okay, it depends upon the customer. You're glad if uh the item you sold to them has good condition, or is in good condition. But although the item is in good condition, part of selling that equipment is part of selling that equipment, or part of the sale of that equipment, is an underlying a warranty expense. Okay, another important note about the use of judgments and estimates is that the use of accounting estimates cannot be abused. Why? Because, oh, we can just have the account estimated, so we no longer need to record anything, let's just estimate. So it's not like that, because um again, the use of judgments and estimates is only for those accounts that cannot be measured precisely, or items in the company that cannot be measured precisely. Okay? Because when you purposely overestimating expenses just to avoid large taxes in the government, it's not legal at all. Okay? So we should not abuse the use of judgments and estimates. Okay, so the next one is prudence. Prudence is so-called conservatism. This is actually related to the use of judgments and estimates, right? So prudence is where an accountant makes sure that income and assets and liabilities and expenses are not overstated. Just like what I've said on the use of judgments and estimates, when you estimate an amount, it should not be abused, because the more the expenses you have, the less revenue you will have, just to avoid taxes. But we should not abuse that, because in accounting, we should practice conservatism. And according to Valix et al. 2013, conservatism means in case of doubt, record any loss and do not record any gain. Just in case, only in case, okay? We are not saying here that all the time you need to abuse uh, the estimation of any amount in the financial statement, just in case of doubt, instead of recording a gain. It's not good as well if you record too much sale in the company, because you have investors, you have creditors, you have employees who are looking up to you. And if you record too much revenue, they are expecting as well their part in the revenue of the business. So if the company is really into the situation where they need to record an expense, or they are in a difficult situation where they need to record um, or where they are unsure on what to record, it's better to record loss than to record gain. Okay, and here are the important notes. Albeit prudence is the preferred course of action when making judgments, deliberately too conservative is not an allowed practice. When you are also too conservative, too much Yeah, just like what we said on the use of judgments and estimates, when we abuse too much, being conservative, we record so much loss, but we do not record any kind and or any amount of gain. It's not also good for the company because it will lead to liquidation of a company. So next is substance over form. So under this concept, in order to truthfully and faithfully represent the financial condition or performance of the company, the accountant should look at the substance of every financial transaction rather than its legal form. Why? Because the legality is not the same with how you treat the financial event in the business transaction. For example, the best example for this concept or principle is the sale of property in the form of lease. Okay, in case the lessee will record an asset. In this case, the lessee will record an asset and a liability in his her accounting records instead of recording an expense. Because since this is a sale of property in the form of lease, you are paying monthly dues as lease. But later, when you have paid all these expenses or all the lease that is agreed between the parties or that was being agreed between the parties, the property will now be turned over to you as your asset. So therefore, instead of recording an expense monthly that will or that might affect your financial condition or that might affect your business, record an asset, since the property in the real nature will be yours in the future. And that expense or the amount of the property that is not yet paid on the foregoing months will be treated as a liability. Okay? So again, there are some transactions or there are some financial events in the business that should be treated on the substance rather than its legal form. Okay, so this is what we are saying a while ago, the going concern assumption. Just like what I've said, there will be no business or there are no businesses who would like to experience liquidation. Because again, under the going concern assumption, it states that the operations of the business will continue indefinitely in the future. When you establish a business, you are aiming for that business to continue in the future. Aside from that, it allows accountants to defer recognition of expenses in the future. And another example for this one, Dr. Vicky Bello opens a new branch in Alabang. She rents a building for 50,000 monthly. She paid the whole amount of rent in advance for 2 years, amounting to 1,200. And on the day of the payment, the company has not yet used the building but already paid the rent. In this principle, the accountant may record assets instead of recording an expense immediately. So under this assumption, under going concern assumption, you need to defer the recognition of expenses the um if the nature of the financial transaction is just like this, that they are paying rent of the building, but they are or they have not yet used the uh, payment. For example, another example of this one is the prepaid cards, because we are paying first the card for future use. We will not we bought that prepaid card for the purpose of not using it immediately, but for the future use. So in that case that you paid first but not yet incurred the expenses, you will record an asset instead of an expense. That's why prepaid expenses are treated as an asset. But the moment you use the rent or the moment you incurred the rent, expenses will be immediately recorded in the financial books. Okay? So examples of a company that is not a going concern. So the results of operations consistently show losses. That's why I've said earlier that it's not also good to record more expenses instead of recording revenue just to escape taxes. And the next one is the inability to pay the obligations in time. Maybe because there is an inappropriate use of the cash or the cash flow of the company is no longer good. Loan defaults. The company has a lot of loans. Suppliers do not sell on credit to the company. When your suppliers no longer want to sell their products to you on credit or on credit or on account. Legal proceedings against the company. When you are already under the lawsuit because you have violated any kind of laws, or when your company do not follow any specific laws that is related to labor unions, to the paying of taxes, and etc. The next is the accounting entity assumption. So under this principle, the business, or we have said on the previous chapters that we have different forms of business like sole, partnership, corporation, and cooperatives. So these businesses are separate from owners, managers, and employees operating the business. So how does it goes? Its main purpose is for the fair presentation of the financial statements of the company. Because a person, for example, who owns multiple businesses, each businesses must be distinct from all the others. So for a clear example of this, a person who owns restaurant, apartment, salon, and etc. So that person has multiple businesses under his name or under her name. That or those businesses must be distinct from each other because they have separate preparation of financial statements. So the next is time period assumption. Under this assumption, it states that the indefinite life of a company can be divided into periods of equal length for the preparation of financial reports. I've said on the previous chapters, especially in the management and in the discussion of the branches of accounting, such as the financial accounting and the management accounting, whereas the financial accounting aims to record financial transactions for a span of one period or annually for the benefit of the creditors and investors or the outside parties, while the management accounting aims to prepare financial matters anytime they wanted to or as long as it is needed by the company for the preparation of management decisions. So, under the time period assumptions, again, the financial statements can be prepared either monthly, quarterly, semi-annually, or annually. And in the general sense, It is usually prepared within the span of 1 year. That's the normal preparation of financial statement. But for the purpose of making decisions or for the purpose of using it for academic purposes, there are companies who prepare their financial statements or transactions either in these periods, monthly, quarterly, semi-annually, and annually. Okay, so here are the important notes. The accounting period of a business may be a calendar year or a fiscal year. When we say calendar year, we follow the calendar from January to December. And when we say fiscal year, it ends any month of the year. What kind of businesses are engaged in fiscal year? The best example for this one are private schools because we are starting, for example, um, the universities in Manila, private universities in Manila, they started their classes last August and will end on May, right? Other private schools who follow the DepEd standards, they started this October and they will end probably on June or on July, whatever month they need to end the school year or the academic year. So they follow fiscal year. And most of the companies follow calendar year from January to December 31. So let's move forward to the generally accepted accounting principles. So under this principle or the GAAP, it consists of different principles, standards, rules, and guidelines that companies follow to achieve consistency and comparability in their financial statements. Again, just like what I've said on the previous chapters of this lesson, that accounting is prepared following a certain standards or accounting reports are prepared following certain standards for comparability purposes and of course consistency for the benefit of their users because we have users that is outside or that are outside the company such as the creditors or potential investors that needs to look into our financial statements that will serve as their basis in making a decision towards the company. For example, the financial investor would like to invest in your company. So he or she needs to look into the other financial statements of other businesses to compare with your businesses if your performance, financial performance, is better than the other existing companies. The same with creditors. They will decide if they would like to lend you money depends on the good performance or depends on the performance of your financial statements. So again, it enhances the consistency and comparability. It helps management understand the trends persistent in the company. So we are also using the standards or we are also following principles, rules, guidelines in the company to understand the different trends. So next is the international financial reporting standards. So these are the two last accounting concepts and principles that we need to follow. So the International Financial Reporting Standards or IFRS, so these are the pronouncements issued by the International Accounting Standards Board or IASB that intend to enhance the comparability of financial statements of all companies around the world. So what is the difference of this to the gap. So the gap is the general basis of all the standards. And this standard is for the international purposes since most of the companies are going global. So we need to have certain standards for the companies to have a comparability and consistency of the preparation. Okay? So what else? In the past, the International Financial Reporting Standards is performed, or the International Accounting Standards Board is performed by the committee, where the pronouncements is called the International Accounting Standards. So before IFRS, we have the so-called IAS, or the International Accounting Standards. And in the Philippines, we follow IAS and IFRS, but considers the USA Financial Accounting Standards Board, or the FASB, the pronouncements of this board, who follows the guidelines provided as well by the GAAP. And in the Philippines, we are already compliant with the International Financial Reporting Standards last January 2005 with the following considerations. Why we consider following these standards. So, Philippine financial organizations' support of international accounting standards, the increasing internationalization of businesses, which greatly calls for a common language for financial reporting, improvement of international accounting standards or removal of free choices of accounting treatments, and the international accounting standards being recognized by the World Bank, Asian Development Bank, and the World Trade Organization. Next, so in the Philippines, we also have our own standards to follow, the Philippine Financial Reporting Standards. But please take note that these standards are not different with the mentioned IFRS or the GAAP, because it is actually aligned to those standards. So again, PFRS corresponds to IFRS. PAS corresponds to IAS, or the Philippine Accounting Standards corresponds to the International Accounting Standards. And here are the important notes about the Philippine Financial Reporting Standards, or PFRS. So the interpretations stated on these standards are issued by the Philippine Interpretations Committee in accordance with the interpretation of the International Financial Reporting Interpretations Committee, or the IFRIC, and the Standing Interpretations Committee, or the SIC. Okay, so that will be all for today. So this is the reference that I used in the content of my discussion for today. Again, Florendo 2016, The Fundamentals of Accountancy Business and Management 1. Thank you so much for listening. I hope you learned something from this chapter, the accounting concepts and principles. So see you again next video. Happy learning!